For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Randy and Jake Floyd of Floyd Financial Group will be your guides for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Good morning. Thank you so much. Welcome to Show Me the Money, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current event headlines. We'll also discuss Social Security's new full retirement age, what it means for 1959 babies and future retirees. We'll talk about AI stocks in the retirement portfolio, opportunity or overhyped, and then finally, how to retire confidently without a pension. My name is Jeff Shade. As always, I'm just here to ask the questions, but the words of wisdom and solid advice, they come from Randy and Jake Floyd of Floyd Financial Group. I'll start with you, Randy. How you doing today?
Doing very well, Jeff. Just excited to be here.
And Jake, how are you doing this fine Saturday morning?
I'm doing great, Jeff. Thanks for asking.
I hope everybody is having a great November weekend. And as always, we really appreciate you listening to us right here for Show Me the Money. Well, let's start off the show today by talking about what's going on in current event headlines. We saw the markets fall again this past week, guys. All three major indexes were down. What do you think is driving this slide?
So, Jeff, I think there's a couple of things. Number one, everybody's just a little nervous about all the stuff that's going on. If you think about it, we always have a lot of things pulling on us, right? We've got the Middle East. We got the peace deal that's going over there. Is it going to hold? We got all the trade dynamics around the globe still happening and unfolding. We got the ever-present Epstein files everybody's worried about and what might come out there. Yeah. And then, of course, we have the Democrats winning the elections in, Seattle and New York City, and then one other place there. And then we got ICE. So there's a lot of things for people to be nervous about. And I just think, too, we've been at all-time highs here recently in all three markets. I mean, when we look at the Dow, that's 30 industrial stocks. If we look at the S&P 500, which is roughly 508 to 510 stocks. We've been at recent highs there at 6,900 plus. And then, of course, the NASDAQ with AI and everything has been running through the roof. And so everybody's saying, are we in a bubble here? What's going on? Now, earnings have come through and held up pretty well. So I think it's just some people got nervous enough. They're starting to do a little profit taking. I still think I'm optimistic. We're going to run higher for sure next year.
Jake, NVIDIA has reported this week, and Wall Street seems laser focused on that. Why are these earnings so important?
A lot of these hyperscalers, as they've been come to be known as in the AI world, there's definitely a lot of back scratching going on in the AI world where NVIDIA writes a deal with OpenAI, OpenAI does a deal with Microsoft, Microsoft in turn does deals with other companies. Palantir is using NVIDIA's chips. The government does a deal with Palantir, right? And so it's all interwoven. And at the center of all this is NVIDIA, because NVIDIA is supplying the hardware necessary to make all this possible. They have north of a 90% market share and no real competitors in sight. There's a few that are trying, but still very behind and not as good. So what happens to NVIDIA is going to reflect on all these different companies because they're spending, in some cases, over $100 billion a year building out their infrastructure. And they need to know that those numbers are still strong at NVIDIA. And so regardless of what happens quarter to quarter in NVIDIA, it's going to remain a centerpiece of this movement looking forward for the next 3 or 4 years for sure.
One thing I would kind of equate this to, Jeff, is right now, everybody said, okay, it's like, where's the money and where's it going? And is there going to be profitability on the other side of this? I think we could equate it back to the interstate highway system we have in this country. Before that was built, and when they started to build interstate highways, I don't know if you remember this or not, people thought that was the stupidest thing imaginable and that it didn't make any sense. And truly, when you first drove, I remember when I-44 was kind of a new concept. Yes, I'm dating myself now. So
yeah.
But I remember when we would drive that big 4-lane highway and you just see a car every once in a while. Yeah. And now it's like you're in town all the time.
Oh, yeah.
So if we don't think that what's happening with AI is going to be the information superhighway like the interstate is to business and things across this country, an artery system, it's going to be. It's just exactly how's it going to play out and when's it going to play out. And people are a little bit nervous about it. Not to mention the fact that if you look at NVIDIA right now as a value, I mean, that company's probably still worth $4.7 trillion, even after its downturn. It was $5 trillion just recently here. And you're approaching 10% of the total stock market in weight. So when you look at that, Apple was the big player for a long time at 7%. When you look at the earnings that these companies have and people's ability to see down the road and to have vision is what's really wreaking a little havoc right now.
We're talking with Randy and Jake Floyd, Floyd Financial Group, of course, our program called Show Me the Money. And during the program today, if you hear anything that interests you, you'd like to come in and sit down and talk to Randy and Jake, the phone number here, 417-889-7233, 417-889-7233. Keep that number in mind if you'd like to set up a no-cost, no-obligation, no-judgment appointment to talk about your journey towards a confident retirement. Guys, we're also hearing that traders are no longer counting on a rate cut in December. What has changed?
Well, with government shutdowns and everything, I think the government is scratching their head about certain numbers that they're looking for. Again, you and I probably could agree, Jeff, that we are never quite sure if those numbers are accurate. However, we just hope they're taking them the same way each time, so at least we have a track to run on, right? Is what we're hopeful for. So I think in light of not having data, they're trying to lean to the more, I don't know if you call it the conservative side, it's certainly the hawkish side of things. However, I do believe that once we get some more data out there, they're going to have to cut, and they're going to continue to cut, because I think we're going to be bleeding jobs pretty substantially, even up in the neck of the woods where you've recently lived. The Starbucks and some of these other companies are laying off people by the thousands right now. So it'll be interesting to watch, but I do think that we will continue to have rate cuts.
Randy, Jake, for retirees, there is a big change coming. The full retirement age for people born in 1959 is now 66 years and 10 months. What do you think this means for listeners approaching retirement?
Yeah, good question. So I think a couple things. Number one, I've been seeing it all over the internet and on any social media that you look at, that this has been some drastic change. This really hasn't been a drastic change. We're just coming to the end of the change that was implemented, I think, almost 20 years ago now, or maybe 25. So basically what it amounts to is soon everybody's going to be at 67 is what it's going to be to get your full retirement benefit. Now, we all know that you can still retire, take your Social Security at age 62, but you will take a permanent cut in pay. And of course, anywhere along the line between 62 and 70, you're going to get a bigger paycheck if you wait through those years. Now, the question always comes in, well, Randy, when should I take my Social Security? And Jake so accurately said one time, he says, well, if you can tell me when you'll draw your last breath, I can tell you exactly when to take it. And so that's the real question there, and none of us know the answer to that. So I always tell people when we talk about this is there's the dollars and cents side of financial planning or taking Social Security, whatever you want to look at here. And then there's the emotional side, and then there's also the physical side. How is your body doing? How's your mind doing? Are you able to continue to work in your chosen profession, or do you really need to retire now? When am I going to enjoy my retirement money more, now or when I'm 80? And also, the age I would take this at, how many more good years am I going to have, and how long does it take to get even? I mean, most times we're looking at, if people take it at 62, it may take 12 or 13 years for them to get even if they had waited and taken it later. And everybody's situation is a little bit different, but it's really something we have to sit down and explore with each person. But really, what does it mean to people? There's really no major change here except for the fact that all the boomers are just getting older.
That's right. We're getting older whether we want to or not. But I think we're still more vibrant than people of our age, many years ago. I think that when I took a look at a picture of my grandpa, he was my age. He looked like he was 80 years old.
Well, in fact, it's funny you bring that up because I was watching this show on TV the other night, and there was a guy that lives up in Siberia, right? This really cold spot. The guy looked, he was like an old leather saddlebag.
Yeah.
And they said he was 63.
Oh my gosh.
Some days I get up and I look in the mirror and I'm thinking, Dad, why am I shaving your face?
Yeah,
like-
exactly.
Looking like the back of Tom Watson's neck.
You know, I was thinking of you the other day. I saw someone mountain biking with a GoPro camera on their helmet, and they were just really going at it. And I was thinking to myself, hey, 60s, what is that, the new 40s? What is that, the new 30s? It's not like it was maybe 20, 30 years ago. Talking about current events with Randy and Jake Floyd of Floyd Financial Group. Let's talk about some catch-up limits for ages 60 to 63. Starting next year, people age 60 to 63 can contribute up to $11,250 in catch-up contributions. How big of a deal is this?
That's a really pretty big deal, especially when we see people that are hitting age 60. They're still vibrant, they're still working, and they're probably making more money than they've ever made in their life. And they have the extra money now because they got the kids through college, they got the house paid off, and maybe they don't have much debt. So now they can really start to save that money. And if you're in a higher income tax bracket, it's always good to be able to save some more money and let the government, what you would have given to the government, fund your retirement later, right?
Right.
So it's a pretty big deal. And for those that are at that age and working full time, I mean, you can put $34,000 nearly into a retirement plan that you don't pay taxes on. If you're in a 30% tax bracket, you know, that's a lot of extra money that the government's not going to get from you. Now, some people say, wait, we got to talk about the Roth and the Roth conversion. Yes, that's certainly a conversation that we should probably have. However, you can also do that with your Roth IRA. Now, you don't get the tax deduction, but you can certainly get that money out there and fund it for a retirement without taxes down the road after 5 years and, of course, past 59 and a half to qualify everything there. But again, it's a conversation that's worth having. If you have a large IRA and you're really in the last 5 or 6 years of life, you might want to contribute money to a Roth rather than taking the extra tax break on your traditional 401k if your company offers such a thing.
Randy, earlier you mentioned Seattle's mayor. I want to touch on this a little bit. I found it interesting that Seattle's mayor is boycotting Starbucks, of all places. I mean, Starbucks, like Boeing and Microsoft, one of the biggest industries in Seattle, Washington. Why is the mayor boycotting Starbucks?
You just got to think about the dizzying intellect of some folks. This gal is 43 years old, and mom and dad paid her rent while she was campaigning. So
That's amazing.
So she can't budget for herself, one individual, and she wants to run what would really be the equivalent in many cases of a small country.
Yeah.
And I'm just not sure that's going to work out. One of the grocery stores and one of the big chains up there said, well, we'll just move out of Seattle. And her comment was, well, I won't allow you, which just shows that she just has no idea what she's talking about in any way. But the Starbucks thing was really mind-blowing to me because here you are inflicting damage to the very thing that supports you.
Yeah. And as you said, the intellect, I do not overestimate the intellect of a lot of these people who are getting into public office these days, but Coffee's a food group in the Seattle area. I lived there for about 10 years or so. Seattle being the major producer of this particular food, so I don't understand that at all. But again, you can go crazy trying to understand the world in general. I want to wrap up something that's interesting. I heard that the last penny was minted this past week. Do you think pennies will ever become a collectible item, considering there were so many of them minted?
All I can say is it's about time. But the answer is yes, of course. It will become collectible. And
Yeah, one day, maybe 100 years from now, they'll go, look, son, it's a penny.
A penny.
there's already pennies that are worth a fortune.
Yeah.
I mean, there's some specific ones from specific years from specific mints that are worth like $100,000 and that kind of thing. But I think definitely pennies will go that route at some point. I'm just personally glad that we won't have to have any more floating around.
I just have one question, and Jeff, you'll probably remember this.
Yeah.
Prior to 1964, most of the coins we made that were like quarters were mostly silver,
Yeah.
dimes, all those things were, right? And then they started putting, I think, copper and stuff in them, and you could even see it. Remember how you could look at the edge and you could see the ones that were made in 64, late 64 and after, they kind of had a gold ridge where that
Right.
copper was in there. What happened to all of those coins?
People hoarded them because they thought they would become collectible. They're not in
But do
circulation.
they still have those, or have they melted them down?
I don't know. They probably,
All that money.
yeah, I don't know. Maybe they pass them on to the kids and the kids just spend. I have no idea what happened to this. I don't have any of them, But nevertheless, I do know what you're talking about. When it comes to pennies, I mean, pennies have been in circulation for so long. There must be billions of pennies out there. But I've always wondered, people come to this country from other countries and they don't understand, first of all, why something is $1.89. And then when you go to pay for it, it's not $1.89. It's like $2.07 or $2.08. And in other countries, they just put the price, including the tax, on it. Do you think we'll ever get to that here in this country?
That's interesting because as we've talked about tariffs and things on here, recently, if you go to Europe, a lot of the things that we ship in over there, they put this thing called a VAT tax, a value added tax, VAT tax on there.
Right.
And it's just included in the price, like you said already.
Yeah.
So they don't say, oh, this is from America, so we'll put another 20% on there. I mean, they do it automatically when it comes into the country.
But how dare we?
Oh, exactly. Don't get me started. Yeah. But anyway, I don't know that we'll ever get there. I think it would certainly simplify things. However, like if you go to Branson, there's a 13% tourist tax. And so it would take Branson's ability to do that out of the equation. I guess they could just add it in somehow. But again, I like the transparency of kind of knowing what I'm paying tax-wise so that I can gripe about it.
I know one thing, we are having too much fun, guys, so let's go ahead and remind people that if you would like to have a little fun with us, if you'd like to come in and sit down and talk with Randy and Jake here at Floyd Financial Group, have a casual conversation about your journey towards confident retirement, it's not going to cost you a dime, and you can set that up right now by calling 417-889-7233. 417-889-7233. You can also find out more about us online at FloydFinancialGroup.com. Randy and Jake, time for a break. When we come back here on Show Me the Money, we're going to be exploring Social Security just a little bit more when our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Randy and Jake Floyd, with Jeff Shade.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and we're going to continue in this segment talking about Social Security and the new full retirement age.
And Randy, Social Security has just bumped the full retirement age for people born in 1959 to 66 and 10 months. Why did this change happen now?
Well, I don't remember the exact date, but 25 years ago or so was when this was really changed, and we started pushing Social Security out. It used to be just 65 was full retirement age. You could go out and you could take it all out. But then they set this up to where it graduated out over the last 20-some years to where it's going to be ultimately 67 for everybody. So there's not been a major change, and I want people to be clear, there's not any major change affecting anybody's benefits out there right now at all. Now, you can look at stuff on the web, and it appears that the wheels have come off in some cases, and that's just simply not the case. I mean, do we have an abundance of extra money in the Social Security program right now? No, but of course it depends on who you talk to as to what that number truly is, and of course they will figure out how to prop it up a little bit more, and each year they do effectively change how much money you have to make. There's a limit as to how much money you make to where you stop paying Social Security. Now, most people never get there, but if you make over, I think the number this next year is 180,000 is where you get to stop paying Social Security payments out of your check. So it doesn't affect a lot of people, but they will continue to raise that and will continue to have more money coming into the Social Security program. But again, is this a really big change for people? Not really. I mean, what it amounts to is if you want to continue to work, maybe even work through age 70, it will affect you a little bit because it used to be at 66 or 65, you could continue to work and still draw all your benefits. Now, if you retire before age 66 and 10, and it will soon be 67, you can only make about $23,000 a year without having to pay part of the Social Security that you have drawn back. So that's the biggest issue here. And again, it's not that it's been a major change. It's been ticking up. This clock has for the last 20, 25 years.
Well, it's going to continue to tick up as well, too, I would think. How much of a reduction is someone looking at if they still choose to claim early at 62 under the new FRA?
Yeah, if you're looking at 62, you're probably talking 25, 26% probably is what you're going to give up. And you give it up on a permanent basis. If you wait till full retirement age after that, so let's say that your full retirement age, you're one of those younger ones and it's going to be 67, you're going to have 3 years of 8% simple interest added to whatever that payment would be at 67. So let's say that at 67, your benefit was going to be $2,000 a month. 8% is another 160, then another 160, and another 160. So you'd add $480 to that $2,000. So by waiting those 3 years, you'd go from $2,000 a month to $2,480 a month. Now you have to remember, people say, well, that's a no-brainer. I'm going to wait. Well, maybe, maybe not. Again, it depends on your health and what's going on with your job and things. But if you think about it, the income you gave up, that $2,000 a month, 24,000 times 3 is 72,000. Well, if you divide 480 into 72,000, that tells you exactly how long you have to live by month to break even. Then anything longer than that, if you have a longer life than that, now you're into plus money by waiting. But again, the old challenge is, do I really need the money at 62 or 64 or 65, whatever it is? Do I want to retire then? And how does that really look for me based on my health and all these other factors, the emotion? Maybe I've got an older spouse. There's lots of things I need to think about when I'm considering, when do I actually take my Social Security?
And Randy, I'm sure there are a lot of people who are listening to us today, and they're listening to the facts and figures and the different computations, and they're saying, I don't care what these guys say. The government has a tremendous debt. Social Security is going to be cut completely. I'm going to take it at 62 because it's just not going to be there. What is your opinion on the future of Social Security as it stands today?
So I'm not a soothsayer. I don't foresee the future, but I will say this. I think that Social Security in some form is going to be here probably for the next couple of decades at least.
Yeah, I think to the people who say that the government doesn't have our best interest at heart and yada yada, I totally agree with that statement. So here's something that will help you understand why Social Security will not go away. Because they want control, not chaos. And if you do not eat from the hand of the government, the bottom third of people that in retirement don't have anything except Social Security. And it will create chaos and anarchy, not control, if they allow Social Security to lapse. I'd say, if anything, we're going to expand Social Security in the form of universal basic income and other things. Again, that's not something I support. I'm just simply saying I think that's what's in the tea leaves.
And Social Security in its current state would run dry, or at least short, I think, by the year 2035. But for those people listening to the program today who are in their 50s or 60s, do you think there's any chance of change at all?
I think there could be some change. As Jake had said, we may be headed for some type of universal basic income. It's being tried in several states right now. Illinois, I know, and some cities are even trying it on some localized basis. And what universal basic income is just basically saying, hey, because I'm living and breathing, I deserve a paycheck, is kind of really what it gets down to. And there's a lot of schools of thought on why people want to do this. And the one really that I guess you could call way out there would be, if we don't give it to them, they'll come and take it from us at gunpoint. Now, I don't want to be negative. I don't think we're going there yet. But again, I think that we are going to have to continue to take care. The Bible says the poor will always be with us and that we should take care of women, children, and orphans. And I want to do that. I want to take care of people. But, I want to make sure at the same time that people are helping themselves as much as they can.
Talking with Randy and Jake, Floyd Financial Group, we're talking about Social Security. Again, if you've got questions about Social Security claiming strategies, call us here, 417-889-7233. Set up an appointment to sit down with Randy and Jake and talk about the proper claiming strategy for you. Once again, no cost, no obligation, and no judgment, 417-889-7233. Randy, the spousal claiming rules haven't changed, but the new FRA does affect the math. How does a higher FRA impact spousal benefits?
Yeah, basically, you're just going to take a little bigger, I'll call it a haircut, if you will, a little bigger haircut as you take benefits at a younger age. So in other words, there's a calculator out on the Social Security website if you want to go out and look at it, and it talks about what's your current age, when do you plan to take benefits, and it talks then about what your actual benefit percentage of max will be. And so depending on what month you take it, if it's, it's 66 and month 2 and your full retirement age is 66 and 10, or maybe you take it at 65 versus 67 as your full retirement age, or you take it at 62, it will show you how much you give up. And then there's also a spousal benefit comparison that will say, hey, if I take mine at this age, and you plug in your numbers there, because there's so many possibilities here, Jeff. I mean, if we look at it from age 62 by month to age 67, we got 5 years, we got 60 possibilities there depending on the month I take it, right?
Right.
So There's a little math involved there. But again, you're just going to take a little bigger haircut as full retirement age goes up. And I should say this too. There is no strategy and there's nothing out there that takes Social Security full benefit any higher than 67. That's it. That's where the end of current legislation is set.
Randy, what should couples with a wide age gap, let's say 5 or 10 years, be thinking about in terms of timing their benefits under the new FRA?
Yeah, so if you're really close timing-wise and you get to turn on Social Security together, that really makes it much easier to retire, right? If one of you is going to be older, though, and you're going to have that gap in there where we're going to have to maybe one keep working, or we're only going to have the one Social Security check, or maybe you had a spouse that stayed home and raised kids over that time, there's a lot of things to think about. And also, you need to look at, so the older person is going to have a much bigger check most likely than the younger one if they take benefits at the same time. And remember that when that person dies, if the older one dies first, and if it's the man, which is most likely that he will pass first, that's going to mean a bigger paycheck for the spouse remaining at home. Of course, if it's the other way around, if we have a larger check by waiting, and if you can, and if you have a pension, if you have a good 401k or IRA savings, maybe it does make sense to delay. But it's one of those things, as we sit down and talk to people, we can really look at all those different scenarios. We'll look and say, hey, if you take it at 62 all the way through age 70, we can see what that looks like. We can look at both of those people sitting down there together, look at their retirement savings, if they have a pension, and we can really engineer a really good outcome, whether they both live a long time together or if one should, unfortunately, predecease the other one and maybe have a lot of years left in life.
Randy, a lot of younger listeners are wondering, well, if this bump to 66 in 10 months is just the beginning, where is it going to go? I mean, will we bump it up to 69, 70? I mean, will full retirement age be 75 at some point in the future?
Well, like I said, right now, 67 is the end of the legislation. So there'll have to be new stuff put out there if we're going to go beyond that 67. And of course, 70 is as long as you can delay at this point, too.
Right. But we were just wondering if that is going to change. I mean, they change everything. There's nothing constant as far as the government goes. I think you mentioned something earlier about, how did you put that?
There's nothing more permanent than a temporary government program, right?
I like that one.
Yeah, that was a famous Milton Friedman quote, I think. The other one I love was, you put the government in charge of the Sahara, and in 5 years there'll be a shortage of sand.
Randy, let's speak directly to the people born in 1959. What should they be doing right now to make the best Social Security claiming decision under this new rule?
Well, the first thing you should do is, and you're going to think this is funny, you should build yourself a Social Security login, but you better be ready to do it when you sit down, because you got to have your driver's license.
Oh, yeah.
You got to have a camera and a good email that you can get to, maybe other than the one on your phone, and be good at picture taking. And I will tell you this, but I'll tell you on mine at least, I had to go out and update because I had an old Social Security login. And so I go out there and I had a driver's license that was just right at 6 years old. So when I went out and I took my picture, it said it wouldn't match up. It said, no, you're not the same person.
Well, of course I'm not the same person as I was 6 years ago.
Tell me something I don't know, right?
Yeah.
So, but they should go out and log in and really figure out what their benefit is at each age. And if they haven't, one of the things that we do when people come in and sit down, part of our discovery process and analysis is we sit down and we say, okay, let's talk about where we are, when you think you want to retire. Let's look at some budgeting. Not that we're trying to put you on a strict budget. We just need to know, what does it take to keep the lights on, keep you fed? What do you think your retirement's going to look like? How much income do you need for what I call play money and fun money? We'll take them through a whole process to really kind of get them to a situation where they go, okay, this is where we are today. Is that where we want to be, or where do we want to go? And then we work a plan to get them to that point and that goal.
We're talking with Randy and Jake, Floyd Financial Group. We're talking about Social Security, the new full retirement age, 66 and 10 months. If you have questions, you'd like to sit down with Randy or Jake here at Floyd Financial Group, once again, 417-889-7233 is the number to call. You can call that number right now if you want. Leave your name, telephone number. Ashley will call you back during the week and set up an appointment for you. No cost, no obligation, no judgment. We'll meet you where you are. So again, Social Security questions, we may be able to help you in terms of claiming strategies. 417-889-7233. We're also online, of course, at FloydFinancialGroup.com. Randy and Jake, let's take a break. When we come back, we're going to be talking about AI stocks and the retirement portfolio, opportunity or overhype, when Show Me the Money continues here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Randy Floyd, Jake Floyd, and Jeff Shane.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in this segment, we're going to be talking about AI stocks and the retirement portfolio. Now, is it good or bad, right?
I don't know. I haven't decided yet, good or bad, but AI is the talk. Everyone's talking about artificial intelligence, and of course, we've had earnings here recently. AI stocks are in the spotlight once again, so let's start big, Randy. Are we in an AI-fueled stock bubble, or is it the real deal?
There's been a lot of speculation on that, and there's been a lot of people looking back historically at where things were during our dot-com bubble, which everybody's kind of saying is similar. And I think the overall consensus and takeaway is that we have a lot more sense of where we're going than we did in 2000. In fact, looking back over our shoulder, and Jeff, you'll remember this, and Jake, you were just too young to remember probably, but I remember when everybody was saying, this is like 1989, malls are closing. They're going out of business because we're going to do everything through e-commerce. Do you remember those days, Jeff?
I do, exactly.
And it was like, next year, all the malls will be a ghost town. Mm-hmm. And this is 1990. Well, here we are. So many years later, 30 years.
We could wish that the malls would be a ghost town.
Yeah.
And that hasn't happened. It took a long time for people. And we know this about lots of things, anything just about. In fact, my father-in-law used to work for Pizza Hut, and he was in marketing there and had a pretty big job with them. And he said, we've been advertising pan pizza for 5 years on national TV, on Super Bowl Sunday, all of it. And he said, we just did a survey, and only 30% of all the people on planet Earth know about pan pizza. And so it just tells you how slow people are to uptake and let things get into their system. So the 1990s, the dot-com bubble, we can see how that played out. I think this is much different. We're already seeing at many levels people using the very beginning stages of AI to shortcut or take the big hassle out of basic research and things like that, or helping you to compile information at least. Of course, as it becomes more reliable, we know right now we have to kind of be careful, but as it becomes more and more reliable, we're going to use it more and more. And again, I think right now we're just simply building the infrastructure superhighway for this. And we know we are. It's happening all across. If you're reading up on this, all these centers they're building, one of the big challenges we have right now is how are we going to power all this stuff, right? It's going to happen.
Yeah, I understand exactly what you're saying. And a lot of this, too, I think of the comparison of the dot-com era as well, too. But I think AI is just a little bit different. So if I'm hearing you correctly, in terms of the tech cycle, Randy, they seem to be boom or bust. And what you're saying today is we're not mid-game or late-stage froth. We're in the early innings at this point. How quickly do you think that we're going to get to late-stage froth or even the middle of the game? Is it going to take 10 years, 20 years? What do you think?
So we've talked about this, so I'll speak for me. I see this as the modern-day industrial revolution. And how long did that play out? It's been playing out since the 20s. So we're 100 years in. How long does AI play out? I don't know, but I would say this. It's definitely going to be a big growth area for everybody listening to this program. We're not going to see the end of this in our lifetime, I'll tell you right now.
Randy, we have seen massive run-ups in companies like NVIDIA, Microsoft, and other AI leaders. Is this level of concentration, do you think, healthy for the market?
Concentration is always a problem from several standpoints. It could be one of the things that we see happen, and this is kind of the concern I think you're speaking to, is generally when companies get big enough and they see a competitor coming up that could cause them a problem, they just go out and buy them up, right? It's kind of what happens there, or merge with them or whatever. Of course, we have the Department of Justice and antitrust and all those different things that will come into play. I think a couple of things. I think with the lowering of interest rates and making capital more available again, I think that will create more small startups. There'll be some of these companies that won't sell, that won't get bought up. And I think we will see it looks more broad on the horizon than it does right now. But yeah, it's kind of problematic as things get too centralized, for sure.
Randy, let's talk to our retirees and our listeners directly here. Should they have AI exposure at all in their portfolios?
Here's what I will tell you. If you're invested in the S&P 500, you have a lot of AI exposure. If you're invested in the Qs or the NASDAQ, you have a ton of AI exposure. And I don't see that there's any way to really avoid it unless you're just saying, I don't want anything to do with technology, period, which would be a huge mistake.
How does AI exposure fit into a retirement plan? I mean, focused on income, stability, and longevity rather than just aggressive growth.
So if we look back over our shoulder, and Jake will probably have a little better feel for this, I'm just kind of off the cuff here. If we look back 10 years, technology as a percentage of the S&P 500 was what, maybe 15, 16%? I'm thinking that's pretty close.
Yeah.
And now it's 30 plus.
And even how tech stocks are defined has changed a lot.
True.
It's technically, I think, 27 or 8% in the actual tech sector, but that does not include Amazon, Tesla, Google, Meta, Netflix. None of those are in the tech sector.
Yeah.
So if you really look at it, what we would have considered tech 20 years ago is probably 60% of the market or something crazy. But the technical number is 27, 28% or so.
Yeah, so to answer your question now, what does it look like inside a retirement portfolio? So there's risk and there's this thing called volatility, right? We're not about going out and taking huge risks. So there's companies out there that we know are not going to go out of business that are going to be the leaders in this, at least for the foreseeable future. Now, one of the things about technology and AI and just the internet age in general is things happen much faster than they used to. Companies that are viable today can be out of business in 5 years and just broke and gone. So things happen much, much faster. But we're looking to be involved in companies in the AI sector and the technology sector that they're large companies, they have great prospects, they have great new contracts coming in, new deals with other AI players, they're innovative. We're not looking to take a big amount of risk like people did buying the Rivian car stock that I refer to all the time on here. That's one of the best ones I can think of. We're also not looking to fall into the trap of buying a Kinder Morgan. Kinder Morgan was an oil and gas stock that used to be really great and really paid lots of dividends, and then they kind of imploded and ate themselves alive, paying dividends they couldn't afford. So we're always looking to be near the cutting edge, but not be over leveraged there. So just know that we're watching and we're looking for trends and companies that are growing and companies that have good prospects and longevity and size when we put those things into a portfolio. But we have to be somewhat where the growth is, but with some safety valves in a retirement program.
Randy, there are people listening who are your age, my age, and we remember the dot-com boom that happened that became a dot bomb. And back in the day, people were raising billions of dollars for dot-coms just because it was a dot-com. And there were kids, in these lofts that were playing ping pong. They really didn't do anything, but they were a dot-com, and people lost money doing that. So let's fast forward ahead here today. For those people who say, I don't want anything to do with this AI entirely, is FOMO the enemy here? Do retirees risk missing out if they avoid AI entirely?
So, Jeff, I think that in the dot-com bubble, yes, a lot of money got lost. A lot of people got hurt. Did the internet change the world?
Absolutely,
yes, it did.
Yeah.
Right? I think both can be true. And while people ask me a lot, are we in a bubble with AI? Yes, we are. The question is, are we 20% inflated? Are we 90% inflated? Where are we? Will we see the inefficiencies in the market the way we did in 1999? 100% we will. The question is AI a bigger deal than the internet even? I think it is. I have to look back at what old Alan Greenspan said. He said that markets can remain irrational longer than you can remain solvent. So these people that are shorting this market and people that are betting against the market, I think are going to be in a world of pain. And while it's certainly not going to be a straight line, as we've seen over the last 10 months or so, it's going to be down and up and all around. I think that it's hard to even put into words the amount of money that's going to be flowing into this opportunity. And is it an opportunity or is it overhyped? Yes.
It's both of those, it sounds like. What signals would indicate ongoing strength versus early signs of overheating as far as AI in general goes, not just NVIDIA?
When you see some of these companies, the Palantirs of the world that have totally detached from any meaningful price to earnings, price to revenue ratio, you should expect some of those to retrace their steps. But you have companies, you have NVIDIA trading at 28 times forward earnings. You got Amazon trading at less multiple than Walmart now. And Amazon's about to overtake Walmart. They're within $1 billion. I think Walmart's annual revenue is at like $693 billion and Amazon's like $692 billion. I mean, I think Amazon is a screaming buy here. If we didn't already own a box full of it, we would be buying some more. And I think there's a lot of these companies are trading cheaper than they have ever traded relative to how much money they're bringing in. So are they expensive on an absolute scale, meaning the stock is high? Maybe. But if you look at it relative to how much money they're making, I think in a lot of cases they look kind of cheap if we're really being honest and objective about it.
Well, I think there's two other things that need to be talked about here, Jake. Number one, anytime you go to build a business, let's say we're building a brick and mortar business to open it and have a retail store. What do we have to do before we could open the store and sell anything? We got to invest in it and we got to build the infrastructure around it, which is exactly what's happening right now. And a perfect example that you talked about is Amazon. I remember in the early 90s, people are investing in Amazon and they've never made a dime. And I'm thinking, what is wrong with these people? What are they doing? What are they thinking? This is crazy. And of course, we know the rest of that story now, don't we?
Well, you were right for 25 years and then it exploded upwards.
You know, is AI going to be here? Absolutely. What's the exact timing? We don't know. So that's why it's just really important that we are always on it, watching it, measuring it, understanding it, seeing what's new. How are things tying together? And that's what we do every day here is look at all that stuff and figure out what's next. Are we always perfect? Absolutely not. And nobody else is. If they tell you they are, you better run.
Right.
That's part of managing a retirement plan.
Is AI an opportunity, a risk, or is it both? If you want the answer to that question, or at least the closest answer we can give us a call here at Floyd Financial Group, 417-889-7233, and request your Floyd Financial Group retirement review, in which we will discuss AI, if that's what's on your mind, or basically anything else that you have questions about. No cost, no obligation, no judgment. We'll meet you where you are. 417-889-7233. We're also online at FloydFinancialGroup.com. Randy and Jake, let's take our final break. When we come back here on Show Me the Money, we're going to be talking about how to retire confidently without a pension. And our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready to climb a mountain of financial know-how? Good, because it's time for more Show Me the Money with your financial Sherpas, Randy and Jake Floyd.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in this segment, we're going to talk about how to confidently retire without a pension.
And Randy, most retirees today do not have a traditional pension. Only about 16% of people do. So let's start with the big picture. How can someone retire confidently without that old school guaranteed paycheck?
For years, Jeff, we would see that people would come in and they would have these pensions. Now it's pretty much limited to teachers and some government workers that come in and really have pension programs, right? So whether that be people that were in law enforcement or some that worked in the medical field still have some. But mainly other than that, it's municipal governments and things of that nature where people have these pension plans. So again, like you said, probably 85 to 90% of the people we see don't have a pension. And you're right. One of the things that kind of weighs on them is maybe their parents had pensions and they don't. And that's kind of like, well, boy, you know what? This is what we got. And I've had that conversation so many times. Randy, I don't have a pension. I got Social Security. This is what we got. We got to make it last. And of course, that's what we're here to do, is to help people get set up to retire and maintain that and not run out of money.
Randy, we hear the phrase DIY pension more and more these days. What does that actually mean for today's retirees, DIY pension?
Yeah, so the people today are looking like, how can I set myself up to have a do-it-yourself, is the DIY thing, of course, pension. And there were some companies for a while that were going out saying, hey, if you buy an annuity contract, what you've done essentially is you've set yourself up a do-it-yourself pension, which is true. The only challenge, of course, and one of the challenges with pensions in general was this. If I had a pension plan that, say, had $500,000 in it, and my monthly pension was going to be $1,500 a month, did it make sense for me to take the $500,000 lump sum or take the pension check? Because once I take the pension check, what do I give up? My lump sum amount, right? There are many ways to set up your own pension plan today. Can we use annuity contracts? Yes. Do we use those? Yes, sometimes. And in fact, a lot of the time for people that are really nervous about how the future may look and mitigating risk being in the stock market, like we've talked about with maybe the AI feature here that's coming into play so much today. But for the most part, when people talk about do-it-yourself pension plans, they were talking early on about annuity contracts. Today, we have a little bit more concise program through using maybe some annuity contracts, using bonds, stocks, and maybe sometimes some alternative investments to get them to that position.
So annuities are one strategy, but as you said, there are some other strategies as well to create this DIY pension or this paycheck in retirement. Some retirees want income that they can't outlive. Randy, are there safe and reliable ways to create that without a pension?
One of the things that we can look at, and we hear about all the time, and people will ask us, what is a reasonable amount for me to withdraw from my retirement plan? And of course, if you go out and you look on the internet, they're going to tell you it's roughly a 4% number adjusted for inflation each year, meaning that if I have a 4% number against my $1 million that I've saved, that's $40,000. Let's say inflation next year is 2%, I'm going to get $40,800, not 2% added to my 4, right? I'm going to get $40,800 to cover the inflation. And they're going to tell you that if you do that, through the market highs and lows, you're going to work out just fine. Now, the challenge is there's this thing called sequence of returns, and we don't ever know exactly. It's like right now, the market has been really good to us the last few years. Is it going to continue, or are we going to have a 2007, 8, and 9? Are we going to have a dot-com bubble? These are the things that roll around in the back of people's minds, and they're right to be concerned about what happens if the market doesn't perform for a couple, 3 years. Am I spending too much money out of my portfolio, and am I going to have a hard time making up those short-term losses that came along while the market rallied or regained composure and started to rally again? So when we go out and we build these portfolios, Jeff, what it amounts to is we are looking at, yes, we want fixed income, but yes, we want some good growth potential, maybe like AI is going to offer us right now. It's a mixture of everything from stocks, bonds, dividends, the whole gamut that we need to look at.
So sequence of return risk is something that can really affect someone's income stream in retirement. How can someone without a pension protect themselves from retiring right into a bad market?
Well, they can't, because none of us can predict that. But here's the thing. If you start off with a plan, and when we build plans here, we're always looking at, okay, and in a way, we have people that retired right in the middle of COVID. In February, March, April of 2020, we were still retiring people at the worst, or what you could call one of the worst times in history, right? Or at least uncertain of what was going to happen. So you can never be sure of what the market is going to do, but we have to build retirement plans that work in all kinds of financial weather, whether that be really good up markets or whether that be markets that are not so good. And of course, it's something that's dynamic. We're always managing that. It's not something that we set it and forget it.
Randy, as part of managing sequence of return risk, having different, I'll call them buckets of money for short-term, mid-term, long-term, what do you think about that strategy?
You know, that strategy works fine for some people. We use that sometimes, but again, we're more really looking at situations where we're managing actively as we go along, day to day, month to month, year to year, to try to put people into the best setups possible. Sometimes if you're looking at bucket strategy, that ties money up for a long period of time, and sometimes that does not work to the client's advantage.
Talking with Randy Floyd here and Jake Floyd at Floyd Financial Group, we are talking about DIY pensions, creating your own paycheck in retirement. Once again, our phone number 417-889-7233. Also online at FloydFinancialGroup.com. So with a DIY pension, of course, we're creating an income stream other than things like Social Security. And really what we're trying to cover here is that income floor. How would you describe an income floor to people listening, and why is it so important for retirees to know what that is and to have that covered?
Yeah, that's a good question, Jeff. So basically, we talked a little bit earlier about having a budget, right? And a lot of times people come in here and they're in their late 50s or their early 60s or maybe even 70, and they're still working and they're getting ready to retire, and they haven't had a budget in years because they paid off their house, they got their kids raised, they made more money than they've ever made before, and there was always more money in the checkbook than they could shake a stick at. And so they just didn't really need one, right? But when we get to the point to where we're going to stop working, and all of a sudden we got to make sense of, what does my 401k mean to me in income? What does Social Security look like? What is my budget? How much money do I need to keep the wolf away from the door each and every month? And of course, how much fun money do I want to have then? But that income floor that you talked about is how do we keep our family fed, keep the insurance on the cars, on the house, keep the roof on the house, buy the things we need to survive. And we want to make sure that we set people up to where they can see for sure that they're always going to have that baseline that they need. And of course, there's going to be good times and bad times. And as the good times come along, maybe we spend a little bit more money in retirement. And when the bad times come in, we know we're still going to be safe until those good times return. And they always do. Markets reset and then they run higher.
Randy, relevant to our conversation here about income floors, I know that you've been in business a long period of time. You've talked to people about what it takes to keep the wolf away from the door, as you say. Do you find that many people underestimate that cost? They'll say, well, it costs me $4,000 a month to live, when in reality, if you add it all up, it costs $7,000. Is that common?
There are a few people that are that way, but for the most part, here in the last bastion of sanity in Springfield, we have a lot of people that are pretty well grounded. Now, I have a few folks that I have to say we're pulling a little aggressively on this. If we have a market downturn, it's going to affect your balance quite a lot, and we need to think about maybe toning this down a little bit, and we analyze maybe what they're spending money on. Again, it's not my job to tell people what they can or cannot spend. It's my job to tell them how it affects their retirement and their portfolio.
Randy, do you find that once people establish that income floor, does their confidence level rise? Are they less stressed about market swings when they know what it costs to live on a basic level?
They absolutely are. And many times what we find too is people that are working in their careers and they're paying Social Security, they're paying insurance, and they're funding their 401ks. Maybe in many cases they're maxing their 401k funds. Maybe they're putting $30,000 a year into a 401k. That's an expense they won't have when they get into retirement, right? So we really start looking at and focusing on it. What is your real paycheck that comes in each month? What is that amount of money that hits your bank account each month? And how much of that are we spending and what are we spending it on? And many times we find out that, they go, wow, I didn't need as much as I thought. But again, be sure that nobody wants to go backwards in retirement. Most people want to live kind of at the same standard. And I often tell people when you're young and healthy and you're wanting to do things, you may spend a little bit more early on than you will later when you're in your 80s and 90s.
Randy, for listeners who are worried that they can't retire comfortably without a pension, what's the first step towards building their own retirement paycheck?
Well, I would like for you to come and sit down with us. Let us get to know you a little bit and kind of help you go down that road, sort that all out. That's really what we're here to do. And you're right that once people get settled in here and we get a retirement plan in place and we've had a few reviews, then they're able to relax and know that there's not going to be any big, coming down the road that they did not see, right? We're going to be talking about those things every time we sit down with them. And we're here to give them confidence, not only in what we're doing, but confidence that they can live their retirement life out, not looking back over their shoulder, but looking forward and having a good time on the roller coaster, fishing, on the cruise, out back watching your cattle, or riding the four-wheeler across your ranch.
Well, I will remind people that if you're looking for a Sherpa, somebody to guide you up that mountain of retirement, you're looking to create a DIY paycheck, you're in the right place here. Randy and Jake Floyd Financial Group can help you do just that. All you've got to do is call 417-889-7233 and talk to us about your needs. No cost, no obligation, no judgment. We'll meet you where you are. 417-889-7233. You can make the call right now. Leave your name, telephone number. Ashley will be back in touch with you during the week, and she'll set you up with that appointment with Randy or Jake here at Floyd Financial Group. 417-889-7233. You're also online at FloydFinancialGroup.com. Well, we're out of time this week, Randy and Jake. I want to thank you for your time, but most importantly, I want to thank our great listeners here in the last bastion of sanity, Springfield, Missouri. So for Randy and Jake, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Show Me the Money on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning is offered through Floyd Financial Group, LLC, an SEC registered investment advisor.